I'm 99 years old, and I've been asked a lot of uncomfortable questions in my life. But there's one question that made an entire room of investors burst into laughter, and it still haunts me today. It happened at the 2019 Daily Journal annual meeting, when someone in the audience stood up and asked, "Charlie, in spite of being partners for so long, why is Warren so much richer than you?" The room erupted. Warren was worth $82 billion at the time. I was worth $1.6 billion. Do the math. That's 50 times richer. 50 times. And I know exactly why. Before I tell you the real story behind that wealth gap, I want you to do something for me. Drop a comment right now with your city and your biggest money fear. Just two things, your city and what keeps you up at night about money. I read every single comment, and I promise you'll understand why this matters by the end of this video. And here's what I want you to promise me in return. Promise me you'll watch this entire video, not because I need the watch time, but because people who stay wealthy finish what they start. That's the first lesson. If you can't commit 40 minutes to learning something that took me 70 years to understand, then you're not ready to build real wealth. Trust yourself. You're here for a reason. Now, let me tell you what I told that room full of investors when they asked why Warren is so much richer than me. I laughed and said, well, he got an earlier start. He's probably a little smarter. He works harder. There are not a lot of reasons. Then I added, why was Albert Einstein poorer than I was? The room laughed again. But I wasn't entirely joking. The truth about wealth isn't what most people think it is. You see, I've spent the last 70 years studying why some people get rich and others don't. And what I've learned will probably surprise you. It's not about intelligence. Einstein was a genius, but he died with a net worth of about $1 million in today's money. It's not about working hard. I know plenty of people who work 80-hour weeks and can barely pay their bills. And it's certainly not about luck. Despite what people say about Warren and me, the real answer to why Warren is so much richer than me comes down to three things that most people never talk about. Three decisions that compound over decades. Three principles that separate the wealthy from everyone else. And by the time I'm done telling you this story, you'll understand not just why Warren has 50 times more money than I do, but more importantly, how you can apply these same principles to your own life. Let me start with the first reason. Warren got an earlier start. Now, most people hear this and think, well, that's obvious. He started investing younger, but that's not what I mean. When I say Warren got an earlier start, I'm talking about something much more fundamental. Warren understood the power of compound interest before most people even knew what it was. I met Warren in 1959. I was 35 years old. He was 29. I had already made my first $1 million in real estate development. And I thought I was pretty smart. Warren, on the other hand, was running a small investment partnership out of Omaha, Nebraska. At the time, I remember thinking, this kid is impressive, but he's just picking stocks. I was building shopping centers and apartment complexes. I was creating tangible value. Or so I thought. But Warren had already figured out something I hadn't. The difference between linear wealth and exponential wealth. My real estate deals were making me good money, but they were essentially linear. I'd develop a property, sell it, make a profit, then start over. Each deal was separate from the last. Warren, meanwhile, was buying pieces of businesses and letting them compound over time. He wasn't just making money. He was creating a wealth-generating machine that worked while he slept. The most powerful force in the universe is compound interest. This quote gets attributed to Einstein, but whether he said it or not doesn't matter. Warren understood it at 29. I didn't fully grasp it until I was well into my 40s. Here's a specific example that will show you what I mean. In 1962, Warren started buying Berkshire Hathaway stock at around $8 per share. It was a failing textile company. But Warren saw something others didn't. By 1965, he controlled the company. Today, those same shares trade for over $500,000 each. That's not a typo. $500,000 per share. The stock has compounded at roughly 20% per year for nearly 60 years. In 1996, I owned 18,829 shares of Berkshire Hathaway Class A stock. At today's prices, that stake would be worth over $10 billion. $10 billion. If I had simply held on to those shares and done nothing else, I would be worth more than $10 billion today. Instead, I'm worth about $2.5 billion. The difference? I gave most of those shares away to charity over the years. Now, before you think I'm complaining about charitable giving, let me be clear. I don't regret those donations. They went to causes I believed in, and the money did a lot of good in the world. But from a pure wealth accumulation perspective, those donations represent the single biggest difference between Warren's net worth and mine. Warren has consistently donated massive amounts to charity as well, but he's done it differently. He's kept the majority of his Berkshire shares and donated appreciated stock in other companies, or committed to give away his wealth after his death. This illustrates a crucial principle that most people don't understand. The timing of when you give away wealth matters enormously for your final net worth. If I had waited to make those donations until my Berkshire shares had appreciated fully, I could have given away the same dollar amounts to charity while retaining a much larger personal fortune. But I was thinking linearly instead of exponentially. Let me give you a specific example of how this works. In 2013, I told the Omaha World-Herald, I'm deliberately taking my net worth down. My thinking is, I'm not immortal, and I won't need it where I'm going. That year, I donated significant amounts of Berkshire stock to various causes. Those shares have continued to appreciate dramatically since then. If I had held them until now and then donated, the charities would have received more money, and I would have retained more wealth. It's a win-win scenario. I didn't fully appreciate it at the time. What I'm about to tell you next reveals the most important lesson I learned from watching Warren build his fortune. It's something that applies whether you have $10,000 or $10 million, and it's the key to long-term wealth preservation. But there's something even more fundamental at play here, something that goes beyond just the timing of charitable giving. Warren and I have approached wealth differently from a philosophical standpoint, and that difference is compounded over decades. Warren has always thought of wealth as a tool for creating more wealth, at least until late in life. He's reinvested virtually everything back into Berkshire, allowing the company to grow and compound. I've always thought of wealth as something to be enjoyed and shared along the way. Neither approach is right or wrong, but they lead to dramatically different outcomes in terms of final net worth. Warren's approach maximizes wealth accumulation, while mine balances wealth accumulation with current enjoyment and philanthropy. The mathematics of compound interest favor Warren's approach overwhelmingly. Every dollar he reinvested in the early years has compounded for decades. Every dollar I spent or gave away stopped compounding immediately. This brings up an interesting paradox that I want you to understand. Sometimes the best financial decision and the best life decision are different things. Warren's relentless focus on wealth accumulation has made him one of the richest people in history, but it's also meant sacrificing other things along the way. He's famously lived in the same modest house in Omaha for decades, drives old cars, and lives relatively simply despite his enormous wealth. I, on the other hand, have enjoyed spending money on things I cared about throughout my life. I've given away hundreds of millions of dollars to causes that mattered to me. I've lived comfortably and traveled extensively. I've had experiences and made an impact that wouldn't have been possible if I had simply hoarded every penny for maximum compound growth. From a pure wealth accumulation standpoint, these were mistakes. From a life satisfaction standpoint, they were among my best decisions. This leads to one of the most important lessons I can share with you. You need to decide what game you're playing. Are you trying to maximize your net worth? Are you trying to maximize your impact on the world? Are you trying to maximize your personal enjoyment and experiences? These are all valid goals, but they require different strategies. Warren has been playing the maximized net worth game for 70 years, and he's won that game spectacularly. I've been playing a more balanced game, and I'm satisfied with my results. In 1996, I owned 18,829 shares of Berkshire Hathaway Class A stock. At today's prices, that stake would be worth over $10 billion. $10 billion. If I had simply held on to those shares and done nothing else, I would be worth more than $10 billion today. Instead, I'm worth about $2.5 billion. The difference? I gave most of those shares away to charity over the years. Now, before you think I'm complaining about charitable giving, let me be clear. I don't regret those donations. They went to causes I believed in, and the money did a lot of good in the world. But from a pure wealth accumulation perspective, those donations represent the single biggest difference between Warren's net worth and mine. Warren has consistently donated massive amounts to charity as well, but he's done it differently. He's kept the majority of his Berkshire shares and donated appreciated stock in other companies, or committed to give away his wealth after his death. This illustrates a crucial principle that most people don't understand. The timing of when you give away wealth matters enormously for your final net worth. If I had waited to make those donations until my Berkshire shares had appreciated fully, I could have given away the same dollar amounts to charity while retaining a much larger personal fortune. But I was thinking linearly instead of exponentially. Let me give you a specific example of how this works. In 2013, I told the Omaha World-Herald, I'm deliberately taking my net worth down. My thinking is, I'm not immortal, and I won't need it where I'm going. That year, I donated significant amounts of Berkshire stock to various causes. Those shares have continued to appreciate dramatically since then. If I had held them until now and then donated, the charities would have received more money, and I would have retained more wealth. It's a win-win scenario. I didn't fully appreciate it at the time. What I'm about to tell you next reveals the most important lesson I learned from watching Warren build his fortune. It's something that applies whether you have $10,000 or $10 million, and it's the key to long-term wealth preservation. But there's something even more fundamental at play here, something that goes beyond just the timing of charitable giving. Warren and I have approached wealth differently from a philosophical standpoint, and that difference is compounded over decades. Warren has always thought of wealth as a tool for creating more wealth, at least until late in life. He's reinvested virtually everything back into Berkshire, allowing the company to grow and compound. I've always thought of wealth as something to be enjoyed and shared along the way. Neither approach is right or wrong, but they lead to dramatically different outcomes in terms of final net worth. Warren's approach maximizes wealth accumulation, while mine balances wealth accumulation with current enjoyment and philanthropy. The mathematics of compound interest favor Warren's approach overwhelmingly. Every dollar he reinvested in the early years has compounded for decades. Every dollar I spent or gave away stopped compounding immediately. This brings up an interesting paradox that I want you to understand. Sometimes the best financial decision and the best life decision are different things. Warren's relentless focus on wealth accumulation has made him one of the richest people in history, but it's also meant sacrificing other things along the way. He's famously lived in the same modest house in Omaha for decades, drives old cars, and lives relatively simply despite his enormous wealth. I, on the other hand, have enjoyed spending money on things I cared about throughout my life. I've given away hundreds of millions of dollars to causes that mattered to me. I've lived comfortably and traveled extensively. I've had experiences and made an impact that wouldn't have been possible if I had simply hoarded every penny for maximum compound growth. From a pure wealth accumulation standpoint, these were mistakes. From a life satisfaction standpoint, they were among my best decisions. This leads to one of the most important lessons I can share with you. You need to decide what game you're playing. Are you trying to maximize your net worth? Are you trying to maximize your impact on the world? Are you trying to maximize your personal enjoyment and experiences? These are all valid goals, but they require different strategies. Warren has been playing the maximized net worth game for 70 years, and he's won that game spectacularly. I've been playing a more balanced game, and I'm satisfied with my results. But here's what most people miss. You can play any of these games successfully, but you have to be intentional about which game you're playing. The biggest financial mistake I see people make is not deciding what they're optimizing for. so they end up with mediocre results in all areas. They don't accumulate enough wealth, they don't have enough impact, and they don't enjoy the journey. Now I want to tell you about something that might surprise you. There's actually a fourth reason Warren is richer than me, and it's one that neither of us talks about much. Warren is simply better at managing his own psychology around money. He's more disciplined, more patient, and more emotionally stable when it comes to financial decisions. This might sound like a small thing, but over decades it makes an enormous difference. Let me give you an example from the 1970s. We were both watching our net worth fluctuate dramatically as the stock market went through various crises. There were times when our Berkshire holdings lost 30, 40, even 50% of their value in a matter of months. I remember feeling anxious, second-guessing our investment thesis, wondering if we should sell some shares and diversify into other assets. Warren, meanwhile, was completely unperturbed. I remember him saying during one particularly bad market downturn, "Charlie, this is exactly what we want. We're buying $1 for 50 cents. If you're not excited about this, you don't understand the business we're in." He wasn't just saying this for my benefit. He genuinely meant it. His emotional response to market volatility was the opposite of most people's. When prices went down, he got excited. When prices went up, he got cautious. This psychological advantage compounded over time. During every market crash, Warren was buying more shares at discounted prices, while others were selling in panic. During every market boom, he was selling overvalued positions, while others were buying at the top. This wasn't because he had better information or superior analytical skills. It was because he had trained himself to think and react differently than the crowd. I've always been pretty good at controlling my emotions around money, but Warren is exceptional. He's developed what I call investment temperament, which is different from just being smart or hardworking. Investment temperament means you can make rational decisions, even when your portfolio is fluctuating wildly, even when the financial media is panicking, even when your friends and family are questioning your judgment. There's a story that illustrates this perfectly. During the 2008 financial crisis, Berkshire's stock price fell from over $140,000 per share to under $70,000 per share. Warren's net worth dropped by about half in less than a year. The financial media was questioning whether Berkshire would survive. Some investors were calling for Warren to retire. I remember getting phone calls from worried shareholders asking if we should change our strategy. Warren's response was to write his famous op-ed in the New York Times titled, "Buy American, I Am." He wasn't just telling others to stay calm. He was putting his money where his mouth was. Berkshire invested billions of dollars in companies like Goldman Sachs and General Electric during the depths of the crisis. These investments made Berkshire enormous profits over the following years. Warren's ability to stay rational and opportunistic during the worst financial crisis since the Great Depression demonstrated the psychological advantage that has contributed to his wealth for decades. I handled the 2008 crisis well, but I have to admit I wasn't as aggressively opportunistic as Warren was. I was more focused on preserving what we had rather than maximizing the opportunity. It's a subtle difference, but it's the difference between extraordinary returns and merely good returns. Over a lifetime of investing, these subtle differences compound into massive wealth gaps. The next part of this story reveals how Warren's approach to learning and decision-making created advantages that most investors never develop. This is the part that can change how you think about building wealth for the rest of your life. This brings me to another crucial difference between Warren and me: our approaches to learning and intellectual development. Warren has always been more systematic about expanding his knowledge base and improving his decision-making frameworks. He reads more, learns more consistently, and applies new knowledge more effectively than anyone I've ever known. When I first met Warren, he was already reading annual reports of hundreds of companies every year. not just skimming them, but studying them intensively. He would read everything from major corporations to tiny regional businesses, looking for patterns and insights. I was more selective in my reading, focusing on deals and opportunities that were immediately relevant to my current projects. Warren was building a vast database of business knowledge that he could draw from for decades. Warren also developed what we call mental models, more systematically than I did initially. He borrowed concepts from psychology, physics, biology, and other disciplines and applied them to business and investing. For example, he understood the psychological concept of social proof and how it creates moats around certain businesses. He understood network effects from studying how systems work in nature. He understood the power of incentives from studying human behavior. I was doing similar cross-disciplinary thinking, but Warren was more methodical about it. He would explicitly seek out new mental models and practice applying them to investment decisions. He treated learning like a systematic process, rather than something that just happened naturally. This gave him a broader toolkit for analyzing opportunities and avoiding mistakes. There's a specific example that illustrates this difference. In the 1980s, we were both learning about the concept of economic moats, sustainable competitive advantages that protect businesses from competition. I understood the concept intellectually and could identify obvious moats, like patents or regulatory advantages. Warren took it further. He developed a whole framework for analyzing different types of moats, how strong they were, how long they might last, and how they could be strengthened over time. This systematic approach to learning and decision-making gave Warren better tools for evaluating investments. While I might look at a company and see that it had some competitive advantages, Warren could analyze exactly what those advantages were, how they worked, how sustainable they were, and what might threaten them in the future. This led to better investment selections and better long-term results. Warren also developed better frameworks for avoiding mistakes, which is just as important as making good decisions. He created checklists and systematic processes for evaluating investments that helped him avoid common errors. He studied his own mistakes and the mistakes of other investors to identify patterns and develop safeguards. I was learning from mistakes too, but Warren was more systematic about turning those lessons into preventive processes. Now let me tell you something that might be the most important part of this entire story. The real secret to Warren's extraordinary wealth isn't any single decision or advantage. It's the compounding effect of small advantages over very long periods of time. Warren is richer than me not because he made one or two brilliant moves, but because he made slightly better decisions consistently for 70 years. Think about it this way. If Warren earned just 2 percentage points more per year than I did on average, that small difference would compound into enormous wealth gaps over decades. 2% doesn't sound like much, but let's do the math. If we both started with $100,000, and I earned 18% per year, while Warren earned 20% per year, after 40 years, I would have about $750 million, while Warren would have about $1.5 billion. That's double the wealth from just a 2 percentage point annual difference. But the actual differences were probably even smaller than that in many individual years. Maybe Warren was just slightly better at avoiding big mistakes. Maybe he was slightly better at recognizing exceptional opportunities. Maybe he was slightly better at holding on to winning investments longer. None of these advantages would be dramatic in any single year, but compounded over decades, they create the kind of wealth differences we see today. This is why I always tell people that building wealth is not about making heroic investment decisions or finding the next big thing. It's about making consistently good decisions for very long periods of time. It's about avoiding big mistakes that can destroy years of progress. It's about understanding that small advantages compound into big advantages if you're patient enough. Most people think about wealth building backwards. They look for the big score, the investment that will make them rich quickly. Warren understood from the beginning that wealth building is about time and consistency, not brilliance and luck. He focused on making good decisions that would compound over decades, rather than spectacular decisions that might work in the short term. There's another aspect of this that people don't appreciate. Warren has been playing the wealth accumulation game for longer than almost anyone else in history. He started seriously investing in his 20s, and he's still actively managing money in his 90s. That's 70 years of compounding. Most people invest seriously for 30 or 40 years at most. Warren has had nearly twice as long for his money to compound, and the later years of compounding are the most powerful. Let me give you a specific example of how this works. Berkshire Hathaway's stock price has increased by about 20% per year on average since Warren took control in 1965. But look at the absolute dollar increases year by year. In the early years, a 20% increase might have meant the stock went from $10 to $12 per share, a $2 increase. Today, a 20% increase means the stock goes from $500,000 to $600,000 per share, a $100,000 increase. The percentage is the same, but the absolute dollar impact is 50,000 times larger. This is the magic of compound interest that most people never experience because they don't invest for long enough or consistently enough. Warren has experienced this magic for 7 decades. I've experienced it for about 5 decades. That 20-year difference in compounding time explains a significant portion of our wealth gap. What I'm about to share with you is the most practical advice from this entire story. These are the specific lessons you can apply immediately, regardless of your current financial situation. So what does all of this mean for you? How can you apply these lessons to your own financial life? Let me give you 5 specific principles that I've learned from watching Warren build his fortune and from reflecting on my own financial decisions over the past 70 years. First, start as early as possible, but don't let a late start discourage you. Warren's early start was crucial to his wealth accumulation, but that doesn't mean you can't build significant wealth if you're starting later in life. The key is understanding that every year you delay starting is a year of potential compounding that you're giving up. If you're 30 and think you're too old to start investing seriously, remember that you potentially have 40 or 50 years of compounding ahead of you. That's plenty of time to build substantial wealth if you're disciplined and consistent. The math is simple but powerful. If you invest $10,000 per year starting at age 30 and earn 10% annually, you'll have about $4.5 million by age 70. If you wait until age 40 to start, you'll have about $1.7 million by age 70. If you wait until age 50, you'll have about $630,000 by age 70. The 10-year delay from 30 to 40 costs you $2.8 million. The delay from 40 to 50 costs you another $1.1 million. Time is the most valuable asset in wealth building, and you can't get it back once it's gone. Second, focus on not losing money rather than on making spectacular gains. Warren's famous rule is, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. This isn't just clever wordplay. It's profound mathematical truth. If you lose 50% of your money, you need to make 100% just to get back to even. If you lose 90% of your money, you need to make 900% to get back to even. Big losses can destroy years or even decades of progress. This means being very careful about speculative investments, avoiding excessive leverage, and never investing money you can't afford to lose in risky ventures. It means being skeptical of investment opportunities that promise unusually high returns with low risk. It means diversifying enough to protect yourself from catastrophic losses, even if diversification reduces your potential for extraordinary gains. Third, develop the temperament to think long-term and act independently. Most of the money in investing is made by doing the opposite of what feels natural. When markets are crashing and everyone is panicking, that's often the best time to buy. When markets are booming and everyone is euphoric, that's often the best time to be cautious. This requires developing emotional discipline that most people never achieve. You can develop this temperament by studying market history, understanding that volatility is normal and temporary, and focusing on the long-term fundamentals of your investments rather than short-term price movements. It also helps to have a systematic investment process that takes emotions out of the equation as much as possible. Regular contributions to low-cost index funds, for example, force you to buy when prices are low and continue buying when prices are high, which averages out to good long-term results. Fourth, be extremely selective about your investments. But when you find something great, invest heavily. Warren's 20-hole punch card concept applies to everyone, not just professional investors. Most people make too many investment decisions and spread their money too thin across too many mediocre opportunities. It's better to make fewer, higher conviction investments in businesses or funds you really understand and believe in. This doesn't mean putting all your money in one stock or one investment. It means doing your homework, finding a few excellent investment opportunities, and allocating meaningful amounts of money to them, rather than sprinkling small amounts across dozens of investments. For most people, this might mean choosing 2 or 3 low-cost index funds that cover different asset classes and investing consistently in those, rather than constantly chasing new investment ideas. Fifth, understand the difference between building wealth and preserving wealth, and be intentional about which phase you're in. In the wealth building phase, you want to maximize growth and compound returns, even if that means taking some risks and living below your means. In the wealth preservation phase, you want to protect what you build and generate income from your assets. The key is recognizing when you transition from one phase to the other and adjusting your strategy accordingly. Warren has been in wealth building mode for his entire career, which has maximized his net worth but required significant sacrifices in terms of current consumption. I transitioned to more of a balanced approach earlier in my life, which reduced my ultimate net worth, but allowed me to enjoy my wealth and make an impact through philanthropy along the way. As I reflect on this question of why Warren is so much richer than me, I realize that the answer reveals something important about success in general. Warren didn't become extraordinarily wealthy because he's extraordinarily different from other successful people. He became extraordinarily wealthy because he's slightly better than other successful people at a few key things, and he's maintained those slight advantages for an extraordinarily long time. This is true in most areas of life, not just wealth building. The best athletes aren't dramatically more talented than other professional athletes. They're slightly more talented, slightly more disciplined, and they maintain those advantages for slightly longer careers. The most successful businesses aren't dramatically different from other successful businesses. They're slightly better at a few key things like customer service or operational efficiency, and they maintain those advantages over time. The lesson for all of us is that extraordinary results come from the compounding effect of small advantages maintained over long periods. You don't need to be dramatically smarter, more talented, or luckier than everyone else. You need to be slightly better at a few important things and maintain those advantages consistently over time. In Warren's case, those few important things were starting early, maintaining emotional discipline during market volatility, being extremely selective about investments, learning systematically, and focusing relentlessly on long-term compound growth. He wasn't dramatically better than other successful investors at any of these things, but he was consistently better at all of them for 7 decades. This is actually encouraging news for most people. It means you don't need to be a genius or take enormous risks to build substantial wealth. You need to identify a few key principles, get slightly better at them than most people, and maintain those advantages consistently over long periods. Time and consistency will do most of the work for you. It also means that the biggest risk to your long-term financial success isn't making a few bad investments or missing out on some opportunities. The biggest risk is giving up too early, getting distracted by short-term results, or constantly changing your strategy. Warren's greatest advantage might simply be that he stuck with the same basic approach for 70 years. Well, most investors change their strategies every few years. There's one more lesson I want to share with you, and it's perhaps the most important one. The question of why Warren is richer than me assumes that being richer is automatically better. That's not necessarily true. Wealth is a tool, not a goal in itself. The question you should ask yourself is not, how can I accumulate the most money possible, but rather, how much money do I need to live the life I want and make the impact I want to make? Warren has chosen to maximize wealth accumulation, and he's been extraordinarily successful at that goal. But that choice has required trade-offs. He's lived modestly, worked constantly, and deferred most of his consumption and philanthropy until late in life. I chose a more balanced approach, enjoying some of my wealth along the way and giving significant amounts to charity while I could see the impact. Both approaches are valid, but they require different strategies and lead to different outcomes. The key is being intentional about your choice. If your goal is to maximize your net worth, then study Warren's approach carefully and be prepared to make the sacrifices that extraordinary wealth accumulation requires. If your goal is to balance wealth building with current enjoyment and philanthropy, then understand that you're optimizing for something other than maximum wealth, and be satisfied with the trade-offs that choice involves. But whatever you choose, don't let the perfect be the enemy of the good. You don't need to be Warren Buffett to build substantial wealth and financial security. You don't need to earn 20% annual returns or become a billionaire to live comfortably and achieve your financial goals. Focus on making consistently good decisions with your money. Avoid big mistakes, and let time do most of the work for you. As I near the end of this story, I want to address something that might be on your mind. You might be thinking, that's all well and good, Charlie, but you're talking about decades of investing and compound growth. What if I don't have decades? What if I'm already in my 50s or 60s and haven't built significant wealth yet? First, remember that even 10 or 15 years of disciplined investing can make a significant difference in your financial situation. The principles I've discussed, avoiding big losses, making selective investments, thinking long-term, work over any time horizon. They just work better over longer time horizons. Second, understand that wealth building isn't just about investment returns. It's also about controlling your expenses, maximizing your earning potential, and being tax efficient with your money. If you're starting later in life, you might need to be more aggressive about these other aspects of wealth building to compensate for the shorter time horizon. Third, consider that your wealth building phase might extend longer than you think. People are living longer and staying healthier later in life than previous generations. You might have 20 or 30 years of potential investment growth ahead of you, even if you're starting in your 50s or 60s. That's still plenty of time for compound growth to work its magic. Finally, remember that the goal isn't to become as wealthy as possible. It's to become wealthy enough to meet your goals and live the life you want. You might not need as much money as you think you do, especially if you're thoughtful about your expenses and realistic about your goals. Building substantial wealth is achievable at any age if you're disciplined and consistent about it. Now let me bring this story full circle. When that investor asked me why Warren is so much richer than me, I gave a brief, humorous answer because it was a public setting, and the full explanation would have taken hours. But the full answer, which I've shared with you today, reveals principles that apply to anyone trying to build wealth over time. Warren is richer than me because he started earlier, worked harder at the right things, maintained better emotional discipline, learned more systematically, and optimized purely for wealth accumulation rather than balancing it with other goals. These advantages were small in any individual year, but they compounded over 7 decades into an enormous wealth gap. The good news is that you can apply these same principles in your own financial life. You can start investing systematically. Focus on avoiding big losses. Develop the temperament to think long term. Be selective about your investments and maintain consistency over time. You can't replicate Warren's exact results because you can't replicate his exact circumstances. But you can achieve substantial financial success using the same fundamental principles. More importantly, you can make intentional choices about what you're optimizing for in your financial life. If you want to maximize wealth accumulation, you can learn from Warren's approach. If you want to find some other balance, you can create your own approach based on these principles. The key is being intentional, being consistent, and being patient. Wealth building is not a get-rich-quick scheme or a game of finding the perfect investment. It's a long-term process of making good decisions consistently over time. It's about understanding that small advantages compound into big advantages if you give them enough time to work. As I said at the beginning of this video, people who stay wealthy finish what they start. If you've watched this far, you've demonstrated the kind of persistence and focus that wealth building requires. Now take that same persistence and focus and apply it to your financial decisions. Make a plan, stick to it, and let time and compound growth do most of the work for you. Remember, the question isn't whether you can become as wealthy as Warren Buffett. The question is whether you can become wealthy enough to achieve your goals and live the life you want. With the right principles, the right mindset, and enough time, the answer to that question is almost certainly yes. And if someone asks you in 30 years why some other investor is richer than you, I hope you'll be able to give them an answer that shows you made intentional choices about what you were optimizing for in your financial life. Because ultimately, that's what separates successful investors from everyone else. Not the size of their bank accounts, but the intentionality of their decisions and the consistency of their execution over time. Thank you for staying with me through this entire story. Now go make it count.